Preparing for a finance manager at Coca-Cola interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your background and explain why you want to become a finance manager at Coca-Cola. I have built my career around turning financial analysis into practical business decisions. In my current role, I lead forecasting, explain performance drivers, and partner with commercial teams on pricing and investment choices. Coca-Cola appeals to me because finance sits close to brands, customers, supply chains, and bottlers, so the work has visible business impact. I am ready to manage a broader agenda, develop people, challenge assumptions constructively, and help improve profitable growth while protecting disciplined capital allocation. While answering, connect your finance experience to leadership, commercial decision-making, forecasting, and stakeholder influence. Explain why Coca-Cola's brands, global scale, bottler system, and consumer-focused culture make the role attractive. Question 2. How would you build an annual operating plan for Coca-Cola? I would begin with strategic priorities and translate them into volume, price, mix, revenue, cost, and cash assumptions. I would work with commercial, supply chain, marketing, and bottling stakeholders to establish bottom-up inputs, then challenge them against market trends and historical performance. After consolidating the plan, I would run upside, base, and downside scenarios, document key risks, and agree accountability. Monthly reviews would compare actuals with plan and update actions, not simply explain variances. Make sure to cover strategic alignment, volume, price, mix, revenue growth management, cost assumptions, risks, scenario planning, ownership, and monthly performance tracking against the approved plan. Question 3. How would you forecast revenue for a Coca-Cola beverage portfolio? I would forecast revenue through a driver-based bridge, starting volume by brand, package, channel, and geography, then applying distribution, pricing, promotion, and mix assumptions. For example, a zero-sugar launch may increase total category volume but also cannibalize the core product. I would incorporate seasonality, customer plans, and bottler information, then compare assumptions with shipment history and market data. The final forecast should explain both the number and the operational actions required to deliver it. In your answer, discuss revenue bridges, volume by channel and package, pricing, promotional effects, product mix, seasonality, distribution changes, cannibalization, and validation against external market indicators. Question 4. What financial metrics would you monitor to evaluate Coca-Cola's performance? I would monitor revenue growth, unit case volume, price and mix, gross margin, operating income, marketing return, free cash flow, and working capital performance. I would not view them only at consolidated level. I would analyze brands, channels, geographies, and bottlers to identify the actual drivers. A strong revenue result with weak volume or deteriorating margin deserves attention. I would pair scorecard metrics with forward-looking indicators such as distribution, promotional intensity, commodity exposure, and customer inventory. Be sure to mention net operating revenues, unit case volume, price/mix, gross margin, operating income, marketing effectiveness, free cash flow, working capital, and metrics segmented by geography, channel, brand, or bottler. Question 5. Tell me about a time you explained a significant variance to senior management. In one quarter, gross margin was 180 basis points below plan. I decomposed the variance into commodity inflation, unfavorable package mix, promotional spending, and a timing issue. I presented an executive bridge, validated the assumptions with procurement and sales, and recommended targeted price actions plus tighter promotion governance. Management approved the actions, and the following quarter recovered approximately 90 basis points. The experience reinforced that senior leaders need a clear driver narrative, financial impact, ownership, and an actionable response. Use a concise STAR structure. Quantify the variance, separate price, volume, mix, timing, and one-off drivers. Explain your analysis, describe the recommendation, and state the measurable outcome. Question 6. How would you evaluate a proposed marketing investment for a Coca-Cola brand? I would evaluate the proposal against an explicit baseline and focus on incremental contribution, not gross sales. I would estimate reach, conversion, volume, price and mix, cannibalization, customer execution, media costs, and timing. Because attribution can be difficult, I would use comparable markets, test and learn designs, or historical benchmarks where available. I would present base and downside cases, define success measures before launch, and complete a post-campaign review to improve future brand investment decisions. Focus on incremental volume, price and mix, contribution margin, cannibalization, media effectiveness, customer execution, timing, attribution challenges, scenario analysis, and post-campaign measurement against a credible baseline. Question 7. How do you approach pricing decisions in a consumer goods business? Pricing should balance revenue growth, consumer affordability, competitive context, and long-term brand health. I would analyze elasticity by product, package, channel, and market, then model price realization alongside volume, mix, promotions, and potential trade down. I would also consider pack architecture because smaller formats can preserve accessibility while improving value per serving. Finance should challenge optimistic assumptions, quantify risks, and monitor post-implementation results so pricing decisions protect both margin and sustainable demand. Discuss elasticity, competitive pricing, pack architecture, affordability, promotional depth, channel differences, price realization, volume impact, retailer relationships, and protecting long-term brand equity. Question 8. Describe how you would manage a forecast when commodity costs are highly volatile. I would first map exposure by commodity, period, supplier, and product, distinguishing contracted costs from open positions. Then I would model sensitivity to relevant price movements and assess available hedging or sourcing information with procurement. The forecast would include a base case, downside case, and recovery assumptions through pricing, mix, productivity, or formulation changes. I would communicate the risk early, update outlooks on a defined cadence, and preserve a consistent baseline so performance remains measurable. Mention exposure mapping, sensitivity analysis, hedging information, procurement collaboration, scenario ranges, price recovery, reformulation or sourcing options, communication cadence, and disciplined updates without constantly changing the baseline. Question 9. What is the difference between revenue growth and profitable growth? Revenue growth is simply an increase in sales, while profitable growth creates incremental earnings and cash after all associated costs. A promotion may lift volume and revenue but destroy value if discounts, logistics, and marketing exceed the contribution generated. I would evaluate growth through price, volume, mix, gross margin, operating expenses, working capital, and cash conversion. At Coca-Cola, the strongest decisions grow brands and customer relationships while improving, or at least protecting, long-term economic returns. In your answer, distinguish sales increases from value creation. Include margin, trade spending, mix, marketing investment, working capital, cash conversion, and whether growth is sustainable after accounting for incremental costs. Question 10. How would you improve the monthly business review process? I would redesign the review around decisions rather than simply reporting actuals. The pack would show a concise scorecard, revenue and profit bridges, forecast changes, key risks, and owners for corrective actions. I would standardize definitions across finance and operating teams, automate recurring data preparation, and reserve discussion for material exceptions. Executive materials should be brief, while operational teams receive deeper detail. Each meeting should end with documented actions, deadlines, and a follow-up mechanism. Be sure to cover decision-oriented reporting, standardized definitions, concise dashboards, driver-based commentary, forecast implications, accountability, action tracking, and tailoring detail to executives versus operational stakeholders. Question 11. Tell me about a time you influenced a commercial stakeholder who disagreed with your analysis. A sales leader wanted to extend a promotion that appeared successful on revenue but was diluting contribution. I first listened to the customer rationale, then rebuilt the analysis by account, package, and incremental volume. We compared the proposed extension with a narrower promotion and agreed on a pilot with clear margin and volume thresholds. The pilot preserved the customer relationship while improving contribution by roughly 12%. I learned that influence comes from respecting commercial realities and offering workable alternatives. Use STAR and demonstrate curiosity, fact-based challenge, listening, relationship management, alternative scenarios, alignment on shared goals, and the eventual business outcome rather than simply winning an argument. Question 12. How would you assess the financial performance of a bottling partner? I would assess the bottler through an integrated view of volume, net revenue, price and mix, concentrate costs, manufacturing and distribution expenses, service levels, working capital, and capital investment. I would compare performance with territory potential and identify whether issues reflect demand, execution, capacity, or economics. I would also distinguish Coca-Cola system value from the bottler's standalone profitability. The objective is a sustainable system outcome, so recommendations should improve consumer availability, bottler returns, and brand growth together. Discuss volume, net revenue, concentrate economics, operating costs, route-to-market efficiency, service levels, working capital, capital expenditure, territory dynamics, and collaboration between Coca-Cola and the bottler. Question 13. What controls are most important in a finance manager role? Key controls include segregation of duties, authorized master data changes, journal entry review, balance sheet reconciliations, revenue recognition procedures, access controls, and documented approval of estimates. I would focus effort on risks that could materially affect reported results, customer deductions, inventory, cash, or management decisions. Controls should be clear, evidenced, and monitored rather than bureaucratic. If an exception occurs, I would identify the root cause, correct the accounting, assess the broader impact, and strengthen the process to prevent recurrence. Mention segregation of duties, journal entry approval, account reconciliations, revenue recognition, master data, access controls, forecast governance, evidence retention, exception monitoring, and a practical risk-based control environment. Question 14. How would you investigate an unexpected decline in gross margin? I would begin with a gross margin bridge against plan and prior year, separating price, volume, mix, commodities, manufacturing efficiency, freight, promotions, foreign exchange, and unusual accounting items. I would drill into products, plants, customers, and markets to isolate concentration. After validating the data with operations and commercial teams, I would distinguish temporary timing from structural deterioration. I would then recommend actions such as price recovery, mix improvement, productivity, or cost containment, and update the outlook transparently. Explain a structured bridge covering pricing, volume, mix, commodities, manufacturing efficiency, freight, promotions, foreign exchange, inventory issues, and accounting classification, followed by validation and corrective action. Question 15. How do you prioritize competing requests from senior stakeholders? I prioritize requests by decision impact, strategic importance, risk, deadline, and effort required. A regulatory issue or major investment decision would generally outrank a routine analysis. I clarify the question, define the minimum useful deliverable, and communicate trade-offs early rather than silently missing deadlines. Where possible, I delegate or automate recurring work. This approach keeps the team responsive while protecting accuracy and ensuring senior stakeholders understand what can be delivered, when, and with what level of confidence. Focus on strategic importance, financial materiality, deadline, decision value, regulatory risk, resource capacity, and transparent communication. Explain how you renegotiate scope while protecting quality and team sustainability. Question 16. Describe a time you improved a finance process through automation or standardization. Our monthly forecast required multiple spreadsheets and consumed nearly 5 days. I mapped the process, standardized account and driver definitions, and partnered with data and IT teams to automate source feeds and validation checks. We reduced manual preparation to 2 days and redirected the saved time toward business analysis. I also retained review controls and documented ownership, so automation did not weaken governance. The improvement gave leaders earlier visibility into risks and created a more consistent forecasting process. Quantify the original problem, explain the process redesign or technology used, address data quality and controls, involve stakeholders, and measure time saved, accuracy improved, or insight delivered. Question 17. How would you manage foreign exchange risk in a global beverage business? I would separate transaction exposure from translation exposure and identify which currencies affect revenue, costs, earnings, and cash. I would quantify sensitivities by market and period, incorporate approved hedging information from Treasury, and model operational responses such as pricing, sourcing, or cost actions. The forecast should show constant currency performance separately from reported results, preventing exchange movements from obscuring business execution. I would communicate both the accounting effect and the economic cash impact to decision makers. Cover transaction and translation exposure, local currency operating drivers, sensitivity analysis, hedging policy, pricing responses, forecast scenarios, cash impacts, and clear coordination with Treasury and regional finance teams. Question 18. What would you do if your forecast missed materially for 2 consecutive quarters? I would take ownership, quantify the miss, and analyze whether it came from volume, price, mix, timing, costs, data quality, or behavioral bias. I would backtest assumptions against actual outcomes and interview commercial and operational owners to understand what changed. Then I would redesign the driver model, introduce explicit scenarios and confidence ranges, and establish earlier warning indicators. I would present management with a recovery plan and track forecast accuracy monthly until performance improves sustainably. Discuss ownership without blame, root cause analysis, assumption backtesting, bias detection, forecast driver redesign, stakeholder challenge, scenario ranges, and a specific improvement plan with measurable accuracy targets. Question 19. How do you develop and motivate a finance team? I set clear priorities, explain why the work matters, and give people ownership of meaningful deliverables. I coach both technical skills and commercial judgment through regular feedback, review assumptions constructively, and create opportunities to present directly to stakeholders. I delegate according to development needs while maintaining appropriate review controls. Recognition should be specific and timely, and accountability should be consistent. My goal is a team that produces reliable analysis, challenges respectfully, and grows future finance leaders. Mention clear expectations, coaching, delegation, technical and commercial development, inclusive communication, feedback, succession planning, recognition, accountability, and connecting individual work to Coca-Cola's broader business purpose. Question 20. Why should Coca-Cola hire you as a finance manager? Coca-Cola should hire me because I combine strong financial discipline with practical commercial judgment. I can build driver-based forecasts, explain performance clearly, challenge investment assumptions, and translate analysis into actions that operators can execute. I also bring a collaborative leadership style. I develop teams, build trust across functions, and remain accountable when results differ from plan. In a complex global system, I would help connect brand growth, bottler economics, margin, cash, and long-term value creation. Close with 3 or 4 differentiated strengths: analytical rigor, commercial partnership, leadership, communication, control discipline, and execution. Support claims with evidence and link them to Coca-Cola's growth agenda. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.